Hello everyone, good afternoon. Welcome to Fund Support Malaysia's webinar session. I'm Yin from the research team and I will be your host today. In this event, we have actually invited Principal Asset Management to share their views on the markets as well as how investors can actually navigate their investment during COVID-19. And in particular, Principal would like to share their views on China, okay? Why is it attractive at this point of time, and what lies ahead for this second largest economy in the world. So before I pass over to the speaker, Mr. Wu, please allow me to give a brief introduction on Mr. Wu. So Mr. Wu Mantai is actually is a head of investment services at Principal Asset Management Berhad. He joined Principal Asset Management as head of investment services since June 2018. He was previously the head of investment management and products with M Private Banking. Mr. Wu brings with him nearly 30 years of experience in the financial industry. Since year 2000, he has served as a portfolio manager for both international and domestic equities. Prior to that, Mr. Wu was an investment analyst, having worked with a number of global investment banks. Without further ado, I'll pass on the session to Mr. Wu.
Hi, good afternoon, everyone. I hope I'm coming through clear. Thanks for attending today's webinar. Today, I hope to share with you what is Principal's view of the markets going forward. I think there's already a lot of news, a lot of data that one can look at. I think the question now is we have reached a stage whereby the whole world is in a lockdown in some form or another. And we are starting to see some results in the lockdown. Market has dropped initially when lockdown happened, especially in China. Market has rebounded when the lockdown, when all the stimulus packages and monetary loosening happened. So what we see now is market seems to have rebounded, stabilized a bit choppy, continue to be choppy. But what is important is the fact that the number of new daily cases around the world seems to have, there's still a lot of new cases, but the number of new cases on a daily basis seems to start to slow down as well. And perhaps for some of these countries like Malaysia, the outstanding number of patients also start to drop. Malaysia has dropped from about over 1,800 outstanding patients to about below 1,005, just above 1,004 now, right? And of course, the leader in all this will be China. At the peak, there's only like about 60,000 patients, and now they are dropped to about below 300. Although some new clusters have come out in China, but this is, I think, something that is anticipated because once you go back to work, social distancing, the strategy become less stringent, more human interaction, and that's when potentially you may have more infections. All right. So please do not be surprised if going forward for the next couple of months, the number of cases in China start to go back above, the number of new cases on a daily basis go back to above 50 or even 100. But that is not a serious number. There's something that they can be controlled. This is where testing is very, very important. Okay, and it also to some extent determine whether the world or even China needs to do more monetary stimulus or fiscal stimulus. All right, but I think the results of all the lockdown are already seen in the global economies. For example, in US, first quarter GDP dropped quarter on quarter 4.8%. But on a year-on-year basis, that means first quarter of 20 compared to first quarter of 19, the US GDP is still a 0.3% growth situation. All right. I think the same may be said for Malaysia. I think by end of this month or early next month, our first quarter GDP number will come up. I think on a quarter-on-quarter basis, we will definitely drop. All right, it will be affected. But on year basis, perhaps it could still be positive. But I think what is important to take into consideration when you position yourself is this. In the second quarter, the number will even be worse. For example, in China, in US, at the peak of the 2008 crisis, quarter on quarter, they dropped over 8% in somewhere in the second or third quarter of 2008. So I wouldn't be surprised for the second quarter of for US, a quarter on quarter drop in second quarter will be at least 8% as well. All right, but this is something to bear in mind, because US and the rest of the world only start to do a serious lockdown somewhere in the middle of March. So for the whole second quarter is that's where most economic activities has ceased, unless it's in a crucial or essential industry. If not, nobody do anything. You just sit around and hopefully that things improved. But just to recap a little bit, we have seen a lockdown. Nobody go anywhere. Demand for oil prices will drop. And of course, we had the drama over a few weeks ago whereby WTI, which is the oil price, the quote that is used in US, whereby it dropped to below zero. That's not surprising, because at this juncture in US, if you are in a lockdown and if you don't have enough storage space and you continue to produce, nobody want to buy anything on a forward basis. That's why prices has dropped. All right, just then you can see it. And anyway, as of now, it has recovered, and it has recovered a little bit more. Just to make the situation clear, there are two benchmark: WTI, West Texas Intermediate, which is generally used by the US, and there is Brent, which is used by the rest of the world, which include Malaysia. All right, and China is the first one that do the lockdown, so it's good to have a look at their track record. They went through a very serious lockdown, total shutdown. Once a week, you're allowed to go out to buy your groceries. Nobody go anywhere. All right, so that's the end of the spectrum whereby it's so strict. And then Malaysia and the rest of the world will be on a slightly lesser extent. Certain things are still being allowed to do. But the difference in results is very clear. The number of cases in China now has dropped below 300. The number of cases on a daily basis is still below 50. All right, and there seems to be less and less death, and you have more and more recovery. All right. But the rest of the world, the number of cases continue to rise, because the number of daily cases is still in the thousands, although it's less than 2 weeks ago, but it's still in thousands. I think you need to see whereby the number of daily new cases in the rest of the world start to drop. And essentially, when the number of new daily cases drop to a certain level, and that coincided with more cases being cured, you will have your outstanding inventory of number of cases drop. All right, that is a very important data point to look out for. All right, I think so. There is a case, I think, whereby everybody had to be sure that you do not open prematurely. Like for example, Malaysia, we have an MCO, then there is a modified MCO, which will be extended into next month of 9th of June. Practically, the government is still very cautious because there's still cases running around. We still do need to do a lot of testing. All right, so that's where the phasing of economic activities is very important. All right, the same like China, they are much stricter, and they slowly phase themselves back into the economy, and they are now 80 to 85% or even more for certain industries they're running. Some people will tell you that the hotels in Sanya, in Hainan, most of them are talking about 85% occupancy. To me, I think that is something, I wouldn't call it dangerous, but you have to be really, really careful when you are staying in a hotel. But I guess being locked out for so long, a lot of people are impatient to get out and do something. All right. Because of the lockdown, whereby non-essential industries are not allowed to do anything, so there's a loss of income, loss of business, and countries around the world, from Asia to US, have done major fiscal stimulus. all the stimulus add together now is equivalent to about 3.7% of GDP. You look at the number back in 08 and 09, you are double what you can get in 2008 and 2009. All right. So that tells you to some extent everybody is keen to combat COVID-19. So everybody wants to sit tight, do MCO, but then by virtue of that, you voluntarily give up doing economic activities. All right. And the government across the world have come in and pumped as much money as possible in the system on standby to ensure that the moment we can start to be business as usual, as we go into business as usual in phases, the amount of money that they have put into the system are ready to be used and for the economy to go forward and we recover from that. So to tell the truth, you look at this, US is one of the biggest in terms of contribution. You look at that, I think the US amount that they are spending is almost equal to 1.5% of global GDP. All right, so there's a big number that we're talking about. Page 11, just to tell you just some details on all those numbers. You can look at that later, but just to tell you how committed everybody, and then to some extent everybody know how serious it is, how important it is to have all the resources available to the economy once they are ready to start operating. All right, so that people can come back and earn a salary. I think everybody is looking at China now because they are the first one to do lockdown. As you can see, their GDP in the first quarter dropped 6.8% year on year. That's really, really very high. And this is because last 2 years, they grow at about 6 to 7%. So that means in one quarter, they gave back what they grew in 1 year. All right. So this is something to consider. Right? But despite this, the Chinese have only done something like 1% of GDP in terms of fiscal stimulus. So that tells you the Chinese government have a lot more space to do fiscal stimulus if they want, and also a lot more space to cut interest rates and do other form of monetary loosening if they want to. Now, talking about all these policies, changes, and adaptation, you will notice that in Asia Pacific countries, we have more room to maneuver. Most of us, our interest rates are still positive. We have more room to cut interest rates. For Malaysia, we just cut 50 basis points in May to bring it down to 2%. And there is more room to cut. Back in 2008, we dropped it to as low as 1%. So that tells you that we can, Malaysia, if necessary, we can still cut interest rate for the next 12 months if necessary. All right. Although I would believe that if everybody is committed and the numbers in the rest of the world start to improve, we may not need to cut interest rates so much. But then there is still something to look at to see how things are. All right. So like you say in China, they have seen a rebound in their PMIs. They dropped very severely in January and February, jumped back above 50 in March, dropped a little bit in April for the manufacturing, but the services PMI continued to grow. All right, so that is not surprising because even though China is ready to produce, they fulfill their orders, but the rest of the world are still combating COVID-19. They are not ready to run as fast as China. So China is in a situation that they are in first in and they are first out. But then to some extent, it's good to be first out. That means you are ready to grow when the market comes. But there is this in-between period from now, maybe until July, August, when the rest of the world are ready to come back. You have this lull period. All right. So that's where I think this is something that everybody has to bear in mind. There's a short-term situation that most of us in Asia may face because our biggest market, which is the developed world, US and Europe, are not really coming back. Because if you think of, those of you who remember, back in middle of, like for example, on page 16, in middle of January, the Chinese come back. They did all the lockdown, institute all the policies, and now by early March, end of April, middle of April, they start to come back into the economy. So if you do this chart, you move everything to middle of March for the rest of us. So we're talking about 3 months or so of a period whereby you need to see results. So March, you're talking about April, May, June. So by somewhere in next month, you see more positive numbers would coming out, even though you may have part of the economy may grow, but the COVID-19 cases need to come off. All right. I think nobody dare to be very serious about going back to work seriously in full force without seeing a drop in the COVID-19 numbers, both in terms of daily new cases as well as the outstanding number of cases, right? Malaysia has had to see that, and even then the Malaysian government is still very cautious, still extend this modified CMO to June 9. So that tells you how important it is that you need to continue to be disciplined and observe the social distancing, because whether you like it or not, I think the fastest that you can get a vaccine onto the market, there was one which is done by Oxford, supposed to be produced by an Indian company. I think we can only see production or see of that somewhere next year, because after testing it on monkeys, you need to do it on humans, and thereafter you need to go through all the regulatory procedures to get it approved before you produce. All right, so it'll be next year to some extent, thereby, and it's a function of who will be able to be vaccinated. All right, so that things of a situation, your portfolio, if you have been staying safe, you write out this particular last 3-4 months of volatility well, but then you still need to think of the fact that there would be continued volatility from now maybe until June, because a few things, right? All the GDP numbers that come out will be bad. All the corporate results that come out will be bad. If that is the case, your bond market, or especially your equity market, will have one more leg of correction, because after the drop in February and early part of March, there was a recovery in third week of March, and market recovered until now. All right, so the Nasdaq has jumped 20%, S&P 500 has jumped 20%, even the KLCI have jumped very well. So that you have this rebound, and even market knows things are bad. Even they say they have taken that into account, but when the real bad numbers come out, market will still have knee-jerk reaction. There will still be negativity seeps in the market, and market will drop. So you still need to ride through the next couple of months or 8 weeks of volatility. And if our base case assumption is correct, all right, all the numbers in the developed world, in US and Europe, starts to come off, and they start to do institute BAU. So you could see July, August, September, whereby economy starts to come back slowly, and in fourth quarter, the rest of the world, including Asia Pacific, will be able to generate a much stronger recovery economic activities, whereby there's a rebound in GDP, right, positively. So one, you talk about next 6 weeks, there is this short-term volatility continue from the fallout from what happened, and thereafter you move into a recovery phase. People are talking about coming back to do business, and a little bit that you talk about a healing process. There'll be more positive numbers, and thereafter an actual recovery. So you would need to position your portfolio, or add money to your portfolio, or rejig your portfolio accordingly as the timeline moved. All right. So this is where, as professionals, investing for your clients, investing for yourself, investing in the portfolio that we run is very important. 3-4 weeks ago, we think of a W-shaped type of situation to the capital market, because there's a recovery. We are seeing that, and there could be a downgrade because of the negative news, political or economics or corporate results. If that is the case, if our base case come through by June, July, COVID-19 data start to turn positive, we need to be positioned for that as well. So we have actually started working as early as 2-3 weeks ago. Have lots of concourse with various corporates around the region, with Malaysian corporates as well, talking to them as to what they think, how they want to reposition themselves, and what sorts of recovery can they think of next year. Because by the time all this come about, it will be past June. Second half of this year, you look into 2021 and 2022 already. So there's no point talking about what's happening this year, all right? They cannot actually give you a clear picture of how the earnings numbers will look like, all right? They'll definitely tell you you'll drop. How much you will drop, they have no idea too. Depends on business, all right? Depends on the client, how much that will happen. So, but you want to talk to them, what they think, consider in terms of their balance sheet, their cash flow, their gearing ratio, how fast they can come back. I think that would be something that we want to determine. And that's where we would start to tilt our portfolio accordingly, right, as it goes. All right. So as it's on page 18, it's just to show you how things are, the cycle of events. All right. I am not surprised that we will eventually hear of a drug that can, or a combination of drugs that can treat COVID-19. But then you have to think of the fact that it's just like SARS or MERS or Ebola. It will be with us complete all the while. Even TB, the virus is not completely killed off. All right, even though Malaysia had not got TB for like 20-30 years, because of migrant workers, all that stuff, it came back. So it's something that we need to live with. And because of that, it's good to have the drugs to increase immunity and able to treat it. But there will always be mutations. And hopefully what we can pray for is the mutation, it become less severe. All right, that would be the best case scenario. Like last time we come up with H1N1, I think now you're talking about H5N11 or something already. So you're talking about the different combination that could happen, which we can't tell at this point. But we need at least a base case drug or vaccination to move forward from there. All right. As I say, this is where first quarter the market is. You see a complete drop. The only thing that didn't drop is actually the bond market. Everywhere have very, very negative markets. But thereafter, it makes a comeback. And just like since 1970s, whenever there is an outbreak of a major new virus or something like that, market will definitely correct, and thereafter it will come back. It's just like when you have a bear market like now, it's a matter of how long this bear market will last, and thereafter the uptrend in the market, how long it will come. You draw a chart, you'll realize that on average, all the bear market lasts about 1 year at best. There will be some shorter ones, there are some longer ones. So there's a possibility the current bear market we started in March could end by, I don't know, November or September. All right, so you give you a 6 months bear market, one of the shortest on record. There's a possibility of that. All right, so that tells you that the importance of always being in the market. You need to be always being invested. But the reality is you just need to be disciplined. You must know your own risk tolerance or your client's risk tolerance, how you want to shift the portfolio as the market cycle comes and go, and how you want to add new investments to take into new developing trend. Like for example, after this COVID-19 thing, what would be a lot of new trends that would come into play? All right. For example, technology on life sciences, pharmaceuticals will even be more important. Certain technologies on remote, equivalent to Skype or Zoom or whatever, will be more important. And also the fact that software application on monitoring of sales on a daily basis, real-time basis through an app, or HR management through an app, these sort of things suddenly will become more important. And also do not forget the fact that the millennials is now more and more of them will coming into the workforce. The millennials are people who are more savvy with technology. they are the ones who will be more adaptable, and going forward with what has happened, they will be the one who drive for more technology change, implementation of more technology being used in the workplace. So this is something to consider, and this is something whereby you want to think of yourself, ask yourself how you want to position your new portfolio for the next 5 to 10 years, because there will be new trends coming. For example, in China, they are talking about new growth areas, new technologies, all right, because they are still factory of the world, but you know that, for example, China is no longer the factory of the world of all the products. They no longer can produce a toothbrush for $1. That's impossible. Cost of production and everything has changed. All right. So we're talking about certain industries whereby China could be more effective in, and certain areas they can, how they want to develop themselves, drive their growth going forward is very important. So this is where also you need to relook at your current portfolios, how you want to tilt your portfolios on the longer term basis as well as on a tactical basis, short term rebound type of situation, right? Just to talk about a little bit of Malaysia, we came out with a 260 billion stimulus package, about 17% of GDP. And Bank Negara will tell you that for this year, we could either have a very small positive growth of 0.5% or negative growth of 2%. All right. And the loss of growth here will be effectively because of we voluntarily just says that we are not going to work, because combating COVID-19 is more important, saving life is more important, because you save life and things normalize, you come back to work. That's the more important part. All right. I'm not going to give more details. I'm sure you have read all of this. Just a breakdown of how they decide to spend the money. All right. I think what is important is there is a lot of relief for SMEs as well as for individuals. SMEs, of course, is very important. It's 70% of the GDP and 75% of employment in the country. We know that there will be failures in the companies. The question is, all this focus is to ensure that the failures, business closing down will be kept to a minimum, so that the loss of occupation, loss of income is kept to acceptable limits. All right, let's be very honest. I don't think we can recover. The whole world can come out of this 100% unchanged. That's quite impossible. All right. Just talk about this. Just to show you on page 26, there's a likelihood, and if most of you follow IMF projection, IMF actually have a 9% growth for Malaysia next year. We actually work it backward to tell you, on average, how is that 9% could be achieved. All right. This is on a straight line assumption now. All right. But policymakers may not report all the numbers, but this is just something to think of. All right. And this is a number that will be the same across all the Asian countries. Next year number and even 2022 numbers will be very strong. A lot of things are postponed. So that also tells you that if the economic number is strong, that means corporate profit number will be strong for 2 years, and how you want to position that as well. That is very, very important. All right. I think just to summarize what is happening, I think the global economies, especially the developed worlds, will go into a technical recession in second quarter and third quarter, year-on-year basis, before coming back in the fourth quarter. All right. We have to look out for second wave, third wave. I think what is important is the fact that until you can show the world your number of outstanding cases drop to, I don't know, like China below 1,000 or below 500 now, that before you can be really aggressive in coming back in BAU, business as usual. So that's where I think the situation is. But short-term basis, we are neutral on equities. But the way I look at it is, we might be neutral on equities, but we are looking at the second leg down. And once we have a sense of how the second leg down to the equity market would look like, we would be talking about how we want to reposition. We have a lot of defensive names in the portfolios. We have REITs in the portfolios that generate great dividend and protect the NAV, but we need to rejig that when things start to look better. We need to tilt the portfolios towards growth, all right? Depends on the type of portfolios that you're talking about, you know, outright aggressive growth or growth with income or pure income. So how the portfolios will be tilted will be differently. We offer all sorts of portfolios in this space. We also have offers outright China-focused funds, which to some extent we have tactical Chinese funds, more core Chinese funds that one can look at in such a situation. We have all of that, all right? And the way I look at it, the Chinese economy will be a first in, first out. I think they will be the first one. I think even the Chinese market have already outperformed the world, have dropped least. I think when by June, July, when the COVID-19 numbers globally start to improve, the Chinese market will run stronger together with other Asian countries who have more successes in combating COVID-19, to some extent, Taiwan and Korea, all right, or even Hong Kong to that extent. Okay. In Asia Pacific, we are positive on Asia Pacific countries, economies on a 12 months basis. Like I says, why? You like to emerge from this particular crisis earlier. There are a lot more companies in Asia who are stronger on a balance sheet basis. I think Asia companies, after surviving 1998, surviving 2008, and surviving 2012, 13, 14, 15 with all the measures, a lot of the Asian companies on the balance sheet basis are very strong. The cost control basis are strong. So I think their likelihood to rebound in terms of overall portfolio is there. And the countries we like in this particular space will be China, Korea, Taiwan, and Singapore. All right. And for Malaysia, we are neutral. We want to see for more clearer developments on corporate results. All right, as well as the economy, as the management of the economy. But we think that there is space to make some money in Malaysia, especially on the fixed income juncture. And equity side, we focus on quality stocks, management quality, profit track record, corporate governance track record is very important at this juncture. So this is where we'll be focused for in terms of our Malaysian portfolio, or even in our regional funds. The Malaysian portion in the regional funds will be using the same type of parameters before we add any Malaysian names. All right. So this is the total thing. At this juncture, tactical 50-50 asset allocation from 60-40 previously. Regionally, we still like large caps. Low gearing. Those with strong business models and able to come back strong. Our advice to our investors is that you have to diversify across asset classes, across geography as well. Focus on stocks that have dividend income, funds that are able to always continuously pay dividends. All right. And for clients who have positioned already conservatively now and able to position themselves for an uptrend in the market towards year end, then we would think that you should be tactically be looking at technology funds as well as China funds as well to track that particular recovery. Now, just some thoughts that we have actually put together after observing the COVID-19 and looking through lots and lots of research. What are the few things that we think would happen? All right. There are things like so-called deglobalization. Now, this is not like closing down of markets and everything. What is certain linkages between the economies may weaken? For example, travel. People may not jump on the plane and just fly off now so easily like last time. You say, oh, I come over and see you because you're my customer and it's time. So there is that thing that the linkage will be different. All right. We need to talk about firms that are highly adaptable and how you're going to do about that. So there are things that implication on certain industries, and certain industry may lose favor You know, people talk about the airlines and hotels industries, how they want to change and price themselves. We have to be look at that very seriously. All right. And to some extent, some people may tell you that government's presence in the global economy will even be bigger and strong, more. That depends on the situation. All right. Therefore, it is something that heads up as you're going to position yourself for the next 12 months or 5 years or 10 years, uptrend to the market or that. This is something to bear in mind for all our clients and investors. All right. Like we say, it's always good to diversify multiple baskets. All right. And to some extent, if you are a grandfather, I think this is a time to think of seriously how you want to start a portfolio for your grandchildren, because a lot of things are at pretty low prices, so you can afford to come in at a pretty attractive cost and have a diverse holdings for your grandchildren if you're thinking of that, even for your children if you are interested in doing that at this juncture. All right. And to some extent, this is the basket of risk that one looks at. All right. I say, please have a goal. That means you are investing for yourself, investing for your clients, investing for your children, and all that stuff. Or you want to maintain your lifestyle after you retire. Where is your current standing? And very important is what is your risk tolerance. All right. You must find a balance. And of course, talk to professionals like people like iFast or whatever other platforms or other fund houses who can give you sound advice. All right. I think to some extent, self-discipline here is very, very important. All right. Okay. Thank you very much. I think that I'll finish with my presentation. I'll be very happy to take questions from the floor.
Hello.
Whether on a macro basis or the fund basis.
Thank you, Mr. Wu, for your insightful presentation. To the audience, if you have questions, feel free to open up the chat box and we will help to address as many questions as possible. Maybe I'll just kickstart the Q&A session with a question on my mind. Mr. Wu, earlier on you shared with us some of the possible prospects as well as the economic outlook on China, right? So if I'm a retail investors that are looking to invest in China, do you have any recommendation in terms of what funds I should consider or look at?
Oh, well, I don't know about my competitor. Let's talk about what Principal have.
Yes.
We have 3 different funds, right? We have a Greater China Equity one that already been around since 2007. Then we have that is a core fund type of situation, is more big cap focus. All right. Then we have an opportunistic fund called China Direct Opportunities, which focus on A-share, CSI 500, small mid caps in China, focus on growth funds. And last year we launched a Greater Bay Fund, which focus on H-share and A-share, especially focus on the China's latest growth area. Like I mentioned earlier, China have gone through a transition for the last 30 years. They've grown very much. They have come to a situation whereby manufacturing is no longer the largest part of the economy. It's only about 30%. Services and consumption is now about 56% of GDP. So they have come to a crossroad whereby they need to refocus on their manufacturing capability, technology capability, and as well as to bring themselves the next driver of growth, which is consumption and services, right? Based on the technology platform or whatever, because they become richer as well. So this is where the situation, they need to transit, right, from that. So I think a few years ago already, they have already highlighted 3 new growth areas that they want to focus on. One will be Beijing and Tianjin area. One is Shanghai, Hangzhou area, and the other one is Guangdong, Shenzhen, and China and Hong Kong and Macau area. That's called the Greater Bay Area. All these three areas will have their own growth dynamics. All these areas will have different industries that they focus on to grow. All right, and for example, the Bay Area is a bit lucky because they have Shenzhen, which is the Silicon Valley of China. Then they have Hong Kong, the financial center. Then they have Macau, which is actually the also the entertainment center for the region. And not to forget the fact that China and to some extent Guangdong and Shenzhen is also a logistic center for China. 4 of the top 10 ports in the world are located in the Greater Bay Area. All right, so it's also a distribution center for that. So you have companies like Alibaba, Tencent, Huawei, BYD is already centered in that part. And to tell the truth, this Bay Area is also modeled along 3 other very successful Bay Areas in the world, which have brought a lot of growth for their country. The first one will be the Tokyo Bay, all right, whereby you have technology and financial services. Then the other 2 Bay Area is the New York Bay, which is more focused on financial services. And New York is one of the richest region in the world, all right? And it's also the #1 financial center in the world. Then currently then you talk about the San Francisco Bay Area, which is in California, whereby you have Palo Alto, the Silicon Valley. All right, so all 3 Bay Areas have brought about unprecedented growth to their region. So I think we believe that the Greater Bay Area will be a one that have the best combination for success and will have the best type of growth that investors can focus on. That's why we have launched the Greater Bay Area Fund. So you have a tactical fund, CSI 500, China Direct Opportunity. Then we have more of a core holding type of fund in the Greater China Fund, Greater China Equity Fund, which includes Taiwan and Hong Kong. And then you have the Greater Bay Fund to focus on the new growth area in China. So I will leave it to you as to how you want to allocate your money among these 3 funds, or if you just want to focus on one fund, also fine, or how you combine them. All right. All 3 funds generally have performed quite well year to date. For example, Greater China has dropped less than 1% on a year-to-date basis. At the peak, it dropped less than 10%. Greater Bay dropped a little bit more, I think, because it dropped about 18-19%, but now it's dropped below 10%. CDOF now it has varied between almost 20% drop to currently about, depending on the currency class, either positive or a small negative. So that depends on how you look at it. But you look at China in depth at this moment, they are focused on reviving their economies. And even the Central Bank of China will tell you that they are not so focused on controlling where the loans growth is. Sustaining growth, coming back to 5-6% growth for China for the next few years is very important. All right, to ensure that China is successful in the transition. Okay, so this is where things are. All right, on that basis.
Okay,
I hope that answered the question.
Yes, we have quite a number of questions, so maybe you can maybe keep the answer a little shorter. Okay, the first question is, she said that you mentioned a possible second wave down in the equity market. Do you think a new low will be set below March 23?
At this juncture, the house view do not think of a new low unless you need to have something really negative happen. There's a few things, right? Your COVID-19 data, I won't say totally positive, but there is improvement. Your economy is starting to opening up. There's some improvement, although the improvement is very narrow. All right, so you need more opening up to be more broad-based. So you have these 2 things supporting, and there's so much money out there ready to support the economy as well as the market. It may test the same low as the 23rd of March, I think. At this juncture, we think the probability of having a lower low is less than 30%, or it's I think less than 20% for us.
Okay, thank you. The next question is about US. What do you think about the US equity market with the current situation, and whether or not it's a good time to buy US tech funds?
Let me put it this way. I can only look at principal tech fund lah.
Yep.
I think we dropped almost 20% at the peak, and now we are almost 5 to 6% up. Because the S&P 500, Nasdaq all recover 20% from the bottom. I think there's still space because I think the penetration of technology will only increases further after the COVID-19, as well as the fact that post this, I think everybody will start to realize that that you need actually better connectivity in terms of your internet. That's where your 5G technology is even more important. And once that is realized, you'll see more implementation of 5G across the world. That which means that it makes application and everything easier. So to some extent, a technology fund should be something that is, I would always be in your portfolio, but how much of it depends on you. You can buy more when it drops, take profit when it drops, but I think it's something that you should always have at this given the way it's moving, unless for whatever reason nobody want to use technology anymore. I think that's quite impossible.
Okay, thank you, Mr. Wu. The next question actually comes from a commodity perspective. So, what's the view on gold? Is it a good time to buy gold, consider the amount of volatility there are in the markets?
I think it's 1,007 now. Personally, I think it's a bit late to jump into gold. Because assuming by June, July, some of the numbers in COVID-19 really improve. So your volatility may actually become more muted. And naturally, you would think that you do not need to have so much gold anymore. All right. And buying gold is difficult in the sense that, one, it doesn't give you a yield. You are not a central bank, and you buy gold, you need to find a place to keep it. Storage space is expensive. All right. I think generally, personally, I rather go on gold ETFs, commodity ETFs, more efficient. All right. If you have gold at this juncture, personally, I'll be taking profit. You need serious third wave, second wave COVID-19 for gold to go higher. Because what it means is when that happens, your economy closes longer, then your economic conditions worsen more, right? That's where that's where gold comes in now.
Okay, the next question, I think this is, Mr. Wu, I think you have mentioned this in one of your presentations. It's regarding the expected recovery timeline from the COVID-19 incident. So one of the participants wanted you to share the time frame for China, Malaysia, as well as a whole globally.
Let me give you the chart. Just now I show it for you. I cannot give you a definite because every country is different. Like Korea, right? You read it, right? Some people go party and suddenly 100 people or more get infected already. So, what it means is you shouldn't party. You want to party at home. All right, at least for the time being. All right. So this is a timeline. At this juncture, you look at it, right? China, before Chinese New Year, lockdown. By middle of March, you almost know that they almost won the battle. Talk about BAU already, all right? Then by middle of April, I think by end of March, you start to see videos. All the nurses go back to those provinces, thousands of kilometers away. You see some of those videos, right? Then by April, mid-April, now early May, most of the industries you talk about above 80% capacity running already. Hotels in Hainan running above. So if there is no major second wave, for example, like I mentioned just now, right, in China, to be logical and you think of it, when you have more human interaction, everybody goes back to work, and you know that COVID-19, there's still no cure, and there are people who have COVID-19, but they are not sick, but they are a carrier and you'll get it. So the number of cases will go up in China. How much more, we don't know. All right. But what is important is you must be able to have the infrastructure to do continuous testing. All right, on a daily basis, to ensure that you detect it early and you keep it under control, or you limit it, you do a lockdown in whatever region, right? So that's what it is. So yeah, I'm talking about 1 month, 2 months, almost 3 months, 1/4 lah. But middle of April, things are really start to move, and 4 months whereby until now, whereby the things will get back to 85%, type of situation. So you move this chart to middle of March for the rest of us, like Malaysia, US, and Europe, and you think that it takes 4 months or more, the same. Now you must remember the fact that China is like a total curfew. You don't do anything. You just sit at home. The rest of us is a slightly looser version of that. So the likelihood of the level of success that China, we may not be able to achieve the level of success of China so fast one. So we may drag a little bit more. So from, let's say, March, April, May, June, June will be whereby, hopefully, whereby the numbers really all turn positive for us. And by middle of July really shows that, yeah, it's time to really open up big time. And by August, perhaps we can be 80-85% in right thing. Of course, in Malaysia, numbers seems, especially from numbers of yesterday, seems to be look quite good. I think we need to see more numbers whereby every day we get less than 50. Every day, given our population of 30 million, I think every day we have less than 10 cases. Is a great sign, right? You have to be proportional to your size of your number of population, okay? And of course, we cannot put that, because every country is different. The level of your healthcare infrastructure, ability to test is also different, all right? Malaysia, Singapore, Taiwan, we may put ourselves in the same level of income, healthcare structure to some extent, and ability to test, all right? So like Malaysia now, we're talking about, number drops. So maybe we can be more normal, faster than everyone by middle of June, all right? While the rest, like Indonesia, may take until August or September, by virtue of the fact that the country is so big, the population is so big, right? This is as approximate or as near as I can put it, all right? But that tells you that how all this timeline overlap, and that also tells you that how agak-agak how you want to start talking about shifting your portfolios for yourself as well as for your clients.
Okay, thank
Would
you,
that be
Mr.
okay?
Wu. Thank you, Mr. Wu. Mike, please hold on. Yeah, I have noted that you have raised your hand. We still have 2 questions before it's your turn. Okay, there are 2 investors that have asked about the recent market movements. So the rebound that you mentioned, more than 20% from the March lows. What has really contributed to the rebound? And do you think the market has moved far ahead of the fundamentals relative to where they should be? Yeah, what's your view on this?
I think the rebound is 2 things, right? One, the rebound is people, the market says, finally you guys woke up and realized that you need to do lockdown. Secondly, thank you for all the free money that you have put on the table for us. So the rebound happened. Before, of course, all this rebound happened before any of the COVID numbers look positive. But all of us know that all this market is 6 months ahead. So you're talking about March rebound, 6 months ahead, September or August. So it to some extent coincide with the situation whereby, in general, base case assumption, if everybody is sufficiently disciplined and have some level of successes in combating COVID-19, your COVID-19 numbers would be across, maybe for a few countries who are poor or are unable to do it properly, we should see more implementation of business as usual. All right. So you're seeing that now. But what now unfolding for the next couple of weeks or 1 month could be a result, knee-jerk reaction to, oh, wow, corporate results really bad, huh? Or wow, GDP growth can really drop so much. So you have all these concerns come back. All right, that's where the W-shaped equity market recovery we are talking about happen.
We'll move on to the next question. Okay, from IK, Mr. Wu, do you mind sharing some views on India?
Okay, let me put it this way. India is too poor and too little infrastructure to have some extent the same timeline as recovery, to be honest. All right, you may have lockdown, everybody wears masks, but it's still a densely populated country. But unfortunately, because the country is poor and insufficient testing, there will be a lot of underreported numbers. All right. So there will always be an element of doubt towards India by investors as a whole. Is unfortunately, those of you who remember, a lot of people keep on asking when everybody in ASEAN have COVID-19, Indonesia don't have. Right. So the same type of doubts will persist for a while for India. That's the reality. How it affects them, I don't know, but their GDP performance may be subpar for a couple of years compared to what they can actually grow. That is a possibility that one can think of. It's very sad to some extent. Yeah.
Okay, thank you, Mr. Wu. I think we have reached the time limit of this session already. We know that there are still a lot of questions that are being unanswered. Please direct all inquiries to investhelp.my@fundsupermart.com, and our client investment specialist team will be happy to assist you with your questions. So to wrap things up, I think the market view that we have communicated earlier is that from principle is that there's still a lot of uncertainty surrounding COVID-19. Okay, for investors that are looking to invest at this point of time should be cautious in terms of their returns expectation in the near term. There could be a lot of volatility that is stemming from negative data or bad data that are surfacing over the due course of March, April, or even May. And as such, investors are advised to, adhere to their risk profiles, stay diversified, and stay prudent in terms of making their investments. Thank you, Mr. Wu, for your time, and thank you everyone for joining us at the FSMR webinar session today. We hope you have taken away something that is useful to you, and we hope to see you guys soon. Stay safe, everyone. Thank you.
Thank you, everyone. Thank you. Thanks for your time. Keep safe. Hopefully, you can meet face to face soon. Thank you.